Welcome to the world of investing, a path filled with incredible potential for building wealth. Many start this journey with high hopes, dreaming of financial freedom and watching their money grow into a substantial nest egg for the future. They open their first brokerage account, filled with excitement. They see charts, numbers, and tickers all representing opportunities. The initial feeling is one of empowerment and control over one's financial destiny, a truly exciting first step. They make their first investment, perhaps in a popular tech company or a well-known index fund. With a click of a button, they are officially an investor. The journey has begun, and the initial outlook is overwhelmingly positive. However, lurking beneath this initial excitement is a single, critical mistake. It's a trap that almost every new investor falls into, and it has nothing to do with which stock they pick or how much money they start with. This mistake isn't taught in finance books or business school. It's a psychological pitfall, a reaction that feels natural but can be financially devastating. Understanding this one concept is more important than any complex trading strategy you might learn. It's the single biggest reason why many new investors underperform the market or even lose money over time. It transforms a powerful wealth-building tool into a source of stress and regret, which is completely avoidable with the right mindset. By the end of this video, you will not only understand this mistake intimately, but you will also be equipped with the simple, powerful mindset needed to avoid it completely, setting you on the path to long-term success. So, what is this colossal error that derails so many promising investment journeys? It all starts when the market inevitably takes a turn. Let's watch what happens to our new, optimistic investor when things don't go as planned. In the beginning, everything goes perfectly. The market is in an upswing and our investor's portfolio value starts to climb. Each day brings positive returns, reinforcing their decision to start investing. Confidence is building rapidly. They check their account frequently, enjoying the sight of the numbers increasing. A $10 gain feels like a major victory. A $100 gain feels like they've unlocked a secret to the financial world that others haven't. This early success creates a powerful sense of confirmation bias. They believe their initial choices were brilliant, not just lucky. They might even start telling friends and family about their newfound skill in picking winning investments. The media echoes this optimism. Headlines are positive, financial news channels are bullish, and experts are predicting continued growth. The entire environment seems to be shouting that this upward trend will last forever and that they got in at the perfect time. This feeling is intoxicating. The investor feels smart, savvy, and in control. The fear of losing money seems distant and irrelevant. Why worry when everything is consistently going up? It feels like the easiest game in the world. They might even be tempted to invest more money, chasing these positive returns. The fear of missing out, or FOMO, starts to creep in. They think about adding more capital to accelerate the growth they are currently experiencing. This period of calm and prosperity is crucial because it sets the emotional stage for the mistake to come. The higher the portfolio climbs, the more the investor has to lose, and the more attached they become to their gains. But markets are cyclical. What goes up must at some point experience a correction, and our investor, conditioned by easy gains and positive news, is completely unprepared for what happens next when the tide inevitably turns. Then, it begins. A small dip in the market. At first, our investor dismisses it as a minor blip, a temporary pause in the upward climb. They've heard that markets fluctuate, so they try not to worry about it. But the next day, the dip continues. The portfolio, once a source of pride, is now flashing red. The unrealized gains start to evaporate, and the initial investment principle is threatened. The easy confidence begins to waver slightly. Suddenly, the news headlines change. Words like volatility, uncertainty, and downturn replace the previous optimism. The same experts who were bullish a week ago are now expressing caution and concern about the near-term future. Our investor starts checking their portfolio more frequently, What was once a fun activity now becomes a source of anxiety. Each check reveals a lower number, amplifying the growing sense of unease and the fear of further declines. Doubt creeps in. Did they make a mistake? Did they buy at the top? The feeling of being a savvy investor is replaced by the nagging fear of being a fool who was simply lucky for a short period of time. They start reading forums and watching financial news obsessively, searching for answers. But all they find is conflicting information. Some say buy the dip, others say a major decline is coming. This only increases their confusion and anxiety. The psychological pressure mounts. The pain of losing money is scientifically proven to be twice as powerful as the pleasure of gaining an equivalent amount. This emotional weight becomes heavier with every percentage point the market drops. This is the critical moment. The investor is at a crossroads, governed not by logic or a long-term plan, but by the powerful, primal emotions of fear and the desire to stop the financial pain from getting any worse. The market drop accelerates. What was a small dip is now a significant downturn. The red on the screen seems to be shouting at them. The paper losses are now substantial, erasing all their previous gains and more. Panic begins to set in. Rational thought is drowned out by a constant loop of what-ifs. What if it goes to zero? What if I lose everything? This emotional noise makes it impossible to think clearly about strategy. Every news alert and market update feels like another blow. The media narrative is now focused on doom and gloom, using sensational language that amplifies the investor's worst fears and makes a recovery seem impossible. The investor imagines their future plans, a house, retirement, travel, all disappearing with their portfolio's value. The abstract numbers on the screen become linked to concrete, painful losses in their real life, intensifying the panic. They feel an overwhelming urge to just make it stop. The primary goal is no longer to make money, but to prevent any further loss. This is a critical psychological shift from an offensive mindset to a purely defensive one. Their finger hovers over the sell button. It seems like the only logical choice, the only way to regain control and end the anxiety. Selling feels like an escape, a way to stop the bleeding and preserve what little is left. Their long-term plan, if they ever had one, is completely forgotten. The initial dream of wealth accumulation has been replaced by the immediate nightmare of wealth destruction. Short-term emotion has completely hijacked their decision-making process. And this is where it happens. Overwhelmed by fear and a desperate need for the pain to end, our investor makes the single biggest mistake a new investor can make. They give in to the panic. They click the button. With a final click, it's done. The assets are sold. The falling numbers on the screen are replaced by a fixed cash balance. The portfolio is no longer declining, but the losses are now permanent and irreversible. Immediately, there might be a fleeting sense of relief. The anxiety of watching the value drop is gone. They have stepped off the roller coaster. This feeling of relief, however, is deceptive and very, very short-lived. This action is called panic selling. It is the act of selling investments due to fear during a market downturn, rather than as part of a pre-planned strategy. It is the literal definition of selling low. By selling, the investor has turned a temporary paper loss into a permanent, real-world financial loss. Before they sold, there was always the possibility of recovery. Now, that possibility for those specific shares is gone forever. This is the cardinal sin of investing. The old adage is buy low, sell high. Panic selling forces you to do the exact opposite. You are guaranteeing a loss by selling at the point of maximum pessimism and fear. The market doesn't care about an individual's emotions. It operates on its own cycles. The investor has reacted to the noise and fear, not to the fundamental value of their investments or their long-term financial goals. They have let short-term volatility dictate their long-term strategy. This single decision, made in a moment of intense fear, can set back their financial goals by years or even decades, depending on the severity of the loss. Now, out of the market and sitting on cash, our investor watches from the sidelines. The immediate pain is over, but a new, more insidious feeling is about to begin as they witness what happens next. And then, as it always has throughout history, the market finds its bottom. The selling pressure eases, and slowly, tentatively, the charts begin to turn. Small green shoots of recovery start to appear among the red. The recovery starts slowly at first, but then it gains momentum. The sharpest rebound days often happen immediately after the worst periods of a downturn. Our investor, sitting in cash, misses these crucial first steps back. Now, a new, painful emotion emerges: regret. They watch the value of the assets they just sold climb higher and higher, knowing they sold at the worst possible time. The relief they felt is gone, replaced by frustration. They face a new dilemma: when to get back in. Buying back now means paying a higher price than what they sold for, which feels like admitting defeat. So they wait, hoping for another dip that may never come. This is the double-edged nature of the mistake. Not only did they lock in their losses by selling low, but they are now positioned to miss the recovery, compounding their error and severely damaging their long-term returns. The market eventually recovers to its previous highs and beyond. For a patient investor who did nothing, their portfolio would be whole again. For our panic seller, their cash balance is a constant reminder of their loss. This entire painful scenario was completely avoidable. The mistake wasn't buying the investment, it was selling it at the wrong time for the wrong reasons. It was letting emotion, not logic, be the portfolio manager. So how do you prevent this from ever happening to you? How do you build the discipline to ride out the storm? The solution is surprisingly simple, but it requires a fundamental shift in your perspective on investing. The antidote to panic is a plan. Before you invest a single dollar, you need to define your goals and your time horizon. Are you investing for retirement in 30 years or a house down payment in 5? Understand that market downturns are not a matter of if, but when. They are a normal, healthy part of the long-term cycle. If you expect them, you won't be surprised or panicked when they arrive. They are opportunities, not threats. Adopt a long-term perspective. Don't view your stocks as daily lottery tickets. View them as ownership in real businesses that grow over decades. The day-to-day noise of the market becomes irrelevant with this mindset. One of the most powerful strategies is dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of what the market is doing. It automates your decision-making and removes emotion. When the market is down, your fixed investment amount buys more shares. When the market is up, it buys fewer. This naturally helps you buy low without having to time the market perfectly, which is nearly impossible. Another key is to avoid checking your portfolio obsessively. If you have a solid plan, you don't need to monitor it daily. Set it, automate it, and let it grow. Checking too often only invites emotional decision-making. Remember the investor who held on. They did nothing. They ignored the panic, trusted their plan, and were rewarded. Sometimes, the most powerful action in investing is inaction, letting time and compounding do the heavy lifting. By having a plan, automating your investments, and focusing on the long term, you build a fortress against fear. You can watch the market dip, knowing it's part of the process, and avoid the single biggest mistake. So, let's recap. The single biggest mistake new investors make is not picking the wrong stock. It's panic selling during a market downturn, letting short-term fear destroy a long-term plan, and locking in permanent losses. The path to successful investing is paved with discipline, not genius. It's about controlling your own emotions, not trying to predict the market's emotions. Your behavior is the single greatest determinant of your returns over time. Remember our two investors. One reacted to fear and locked in a loss. The other had a plan, stayed the course, and saw their wealth recover and grow. The only difference was their mindset during the period of turbulence. Before you invest, create a simple plan. Write down your goals and your strategy for when the market inevitably drops. This simple document will be your anchor in a sea of fear, guiding you to make rational decisions. Don't let a temporary market decline scare you away from your long-term financial goals. Embrace volatility as an opportunity and trust in the process. Your future self will be incredibly grateful for your patience and discipline today. Investing is a marathon, not a sprint. The winners are not the ones who avoid every dip, but the ones who keep running, stay on the path, and don't get spooked by the weather along the way. If you found this advice helpful and want to learn more about building wealth with a smart, disciplined approach, make sure to subscribe to our channel. We provide clear, simple strategies to help you on your financial journey. Thank you for watching. Remember to invest with a plan, control your emotions, and think long-term. By avoiding this one mistake, you are already ahead of the vast majority of new investors. Stay wise and stay invested.